CPI stands for Consumer Price Index, which is a measure of the average change over time in the prices paid by consumers for a basket of goods and services. It is commonly used as an indicator of inflation, which is the rate at which the general level of prices for goods and services is rising. The CPI is calculated by tracking the prices of a predetermined set of goods and services over time, and comparing them to a baseline period. The difference in prices is then expressed as a percentage change, which reflects the rate of inflation or deflation. The CPI is used by governments, policymakers, and businesses to monitor and adjust economic policies and activities. The Consumer Price Index, CPI, can have a significant influence on forex markets as it provides an indication of the overall inflation rate of an economy. In general, higher inflation rates will lead to a decrease in the purchasing power of a country's currency, which can cause its value to depreciate relative to other currencies. This is because investors may seek to invest in countries with lower inflation rates, as their currency is likely to maintain its value better over time. As a result, forex traders closely monitor CPI releases as they can provide clues about potential shifts in central bank monetary policy, which can in turn affect interest rates and currency valuations. If a country's CPI comes in higher than expected, it may signal that the central bank may be more likely to raise interest rates to combat inflation. This can cause an increase in demand for that currency, leading to appreciation in its value relative to other currencies. If a country's CPI comes in lower than expected, it may signal that the central bank may be more likely to keep interest rates low to stimulate economic growth. This can lead to a decrease in demand for that currency, causing it to depreciate relative to other currencies. Traders can use CPI results as a key piece of information when making trading decisions. CPI releases can provide important insight into a country's economic health and the potential direction of its monetary policy, which can in turn affect currency valuations. In general, a higher than expected CPI result can lead to an increase in demand for a currency, as it may signal that the central bank is more likely to raise interest rates in order to combat inflation. This can cause the currency to appreciate relative to other currencies, and traders may look for opportunities to buy that currency or enter long positions. Conversely, a lower than expected CPI result can lead to a decrease in demand for a currency, as it may signal that the central bank is more likely to keep interest rates low to stimulate economic growth. This can cause the currency to depreciate relative to other currencies, and traders may look for opportunities to sell that currency or enter short positions. It's important to note that the impact of CPI results on trade decisions is not always straightforward and can be influenced by a wide range of other factors, including political and economic developments, global events, and technical analysis. As such, it's important for traders to consider a range of factors when making trade decisions and to use sound risk management practices to protect themselves against potential losses. Overall, it's important to note that CPI results are just one piece of information that traders use to make trading decisions, and other factors such as political and economic developments, global events, and technical analysis can also have a significant impact on currency valuations. As such, it's important for traders to use a range of tools and analysis methods to make informed trading decisions and manage risk effectively.